Hello, Face. I want to welcome all the members that took advantage of our Cyber Monday sale. I know it's going to be a good decision for you. So welcome to our trading community. Let's talk about 78.6. Well, it's really a fib I like because a lot of people don't use it. Actually, you know, they use 38.50, 61.8. Okay, that's most of it that people really pay attention to conventionally. What I like about 78.6 is it takes out all the retracement buyers. They're giving up the ship. So here we had Euro retracing 78.6 of this move here from the 1220 low. And we ended up with a throw over or throw under underneath this wedge. So back into this wedge, it would look pretty good. Looks like it's coming in a little bit under 113. So you get a candle closing back inside the wedge. You have a pretty good probability that it's going to test the upper side of the wedge, which is, you know, going to come in around 13.5 or so. And then if you believe in the breakout, maybe the first breakout is a fake out. And then I know I'm getting ahead of myself. We could break out over this downtrend line, and that comes in at 1360, and you tack on 220, which was the move that we had from the lows to the highs up here, and you could get 1580, and 1580 is I think it's up here, yeah. 1580 is going to be this broader channel and the bigger wedge. So we'll take a look at that being the possibility that we get a reversal there. Another market that's at 78.6 is the yen. And it surprised me that it was able to accomplish it after a breakdown out of a falling wedge. But here we are, it's playing with the 78.6 level, risk on. And we have a great guest today. Edward Harrison, his bailiwick is bond markets, and, you know, not just treasuries, but corporates, junk, everything. So we're going to get a pretty good perspective from our guest today about what he thinks is happening in the debt markets across the board, because, you know, rates are the tail wagging the dog on the dollar. The dollar is the tail wagging the dog on equities and commodities and even equities. Equities really getting squeezing people pretty good here. Jim Welsh, who was a guest of mine, sent out a piece, and he rode the whole move down from that 2800 level, the 61.8, and covered shorts. And he was talking about the potential of 28.15 or so again. So it looks like we're going to have Santa's showing up. It's not December yet, but they have the bears under duress. Greg talked about that as well. Greg, a bullish DAX. So also we're at a pretty critical support level for the gold. There's one more left. If this one doesn't hold, we're lower today. Not by much. I actually took a shot in here yesterday, but this 12 level is pretty significant. If we don't hold this, we're headed for 1196. Now, if we're right, and Greg is right, and a lot of people who, you know, the COT and everything really hasn't changed in the dollar. There's, you know, very bearish setup in the dollar with everyone being on the bullish side of the boat. So we'll see if gold could make a stand here at this 1214 level. Does look a little bit like maybe it's a, you know, this was a left shoulder head. Maybe we're putting in a right shoulder here. And if gold's a little bit too fast for you and you're a senior citizen like me, I do a lot of tradings in ETFs. So I took a shot yesterday in the nugget, which is 3 times. So if we hold here and gold gets a move, we could head up towards 20, especially if we're going to have that move up towards 1260. in the gold, 1280 in the gold. That still could be considered a bear market rally. I just want to remind people that being part of our family and our team, that if you're not satisfied with what's happening with your broker, you can get rebates. Okay, so you get a hold of Trent and Justin at Forest Park FX. They are the sponsor of this free webinar. So you can at least call them and thank them for sponsoring this, and tell them where you trade and get to know them, because you might be up for a cool change. If you don't know what I mean by cool change, it's the Little River Band. I know you can't hear this, but I'm always up for a cool change. How about you? Everyone? Okay, Kareem. So stick around for Edward. And with that being said, I'm just going to pass the baton over to Blake, see what he's thinking going into this morning, especially dollar-wise, what he's thinking in here. How are you today, partner?
I'm doing well. Good morning.
Good morning.
Let me make sure. Oh, yeah. Can you hear me okay? I was just making sure.
Yeah, very loud and clear, bro.
How's it going today?
Good. So, no turnaround Tuesday in much yesterday. Everything kind of continued in the same direction. Curious as to, if you think, we took out that 113 level, still looks like it's a pivot. And yeah, we still haven't made a new high in the dollar. Do you think there's destiny for a new high, Blake, or it could, fail here?
I don't know. I mean, this is the dollar view that I've got right now, which isn't, saying much. And, as we approach those recent highs above 97, we got a minor channel high that we're contending with, and the 88% retracement, which, thinking out loud that if this is truly, if we reject here, which I don't know why that's there, because we're not going there. I'm trying to delete this. Hold on. So looking at the dollar, if we reject the 88-cent level, then, or 88% level, then what we're probably doing is some sort of we're doing some sort of consolidation.
Which, yeah, that's another fib that a lot of people don't use. So
it isn't. It's kind of like that. That's the if we test it and we respect it, then that means there's a more of a consolidation type of phase coming, meaning that even if the dollar comes down to 96.70, that there's a high probability that we're just let me draw it out for you guys.
That's pretty interesting. So the stronger the retracement, and 88.6 being the biggest retrace a market could have without taking out a higher low, it implies that any move off of it is corrective rather than reversal, in nature.
So
okay.
Exactly. So when you get like a 38% retracement, let's say off of a down move, like, let's say we would have stopped here, it's a weak bounce, and then there's a higher chance that if we break, there's going to be a big continuation.
Right.
Once you get past like the 50% and more like the 618 or the 786, then you go into consolidation. And so that's, so if you're like, oh, I'm going to short the dollar, or short the dollar here, and I'm expecting a move down to here, that's a tough, much lower probability than the 88% retracement just giving you some sort of consolidation, which doesn't mean, it doesn't mean that the dollar can't reverse and we can't see a complete reversal here. It's just the chances of that happening become a lot less. So, so as far as the dollar goes right now, it
that's
is
a nugget.
Well, hopefully you guys can, use that as a little bit of a takeaway. I'll tell you what, though, I'm so frustrated with this market, and there's not a lot to do. And my lack of patterns in play is really a testament. When you see the only pattern in play I have is the Aussie New Zealand, and it really is, and it's the only one I've put out for probably like 2 weeks, because there is nothing going on. And look, I'm still out there trading, and I'm trading, very well, a little bit smaller, and then normal, and it's very frustrating. Like, for example, I am short some dollars. I've been long the euro for a couple of days, and it's going against me. It's not going against me huge. It's more of a frustrating grind, and it's it's small position, so it's not wreaking havoc on my trading. It's just more of annoyance than anything. And because we're seeing this, and then just go with the dollar, like the divergent relative strength, you're seeing it pretty much everywhere. I mean, it doesn't matter where you look. If you're looking at the dollar, moving, against even other, currencies, it's just, divergent relative strength. So the moves are just weak, but it's a grind. And, maybe we get a little bit of light from Chairman Powell today, and he's going to be, now he is talking today at the he's delivering a speech, the Federal Reserve's Framework for Monitoring Financial Stability, at the Economic Club of New York. Is that going to yield any type of real big moves? I'm hoping so, but after Clarita, the vice chair yesterday, and the relatively hawkish comments from Clarita, I don't think anybody's really expecting any dovish comments from Powell. So, are we going to get any move from here? I don't know. I'm hoping so. I'm really hoping that we see something before Friday, because before the G20, because what I'm hoping to do is see some sort of movement, just to see some action, to be able to have an opportunity to make a little bit of money between now and the weekend. Because the weekend, we're waiting on the G20. We're not going to know anything until how things are going until Sunday evening, and the markets are going to gap one direction or the other. So I'll give you my thoughts on the G20 meeting here in just a second, but which I think I alluded to already this last week and for the week ahead video. But before I do that, I got something more important to talk about. Do I have you on pins and needles, Dale?
Yeah, buddy. Is it the interview Friday?
Yes. All right, guys. So the interview on Friday, and I've actually got to get with him today and test his microphone, because he doesn't use mics. Ronnie Schlapfer is one of the traders that you would, if you've ever watched the $1 Billion Day BBC interview. How many of you guys, tell me, how many of you guys have watched the BBC? And I'm reading the questions in the Q&A panel. How many of you guys have watched the BBC $1 Billion Day documentary from like 1986? Nidja says way too many times. Scott says me. Mark, yes. Steve, Marshall, yes. Alan did. Tamer says the one you sent, I did. Andy says 4 times. Simon says yes, I watched it. Todd, Jason, Morrow, Amanda has, and Oliver says not yet. Oliver, my God. So the $1 Billion Day documentary, one of the gentlemen featured in the documentary, the gentleman from New York, actually he's Swiss, but he was living in New York at the time. His name's Ronnie Schlapfer, and this is going to be a first-time interview for him. He's never really been. I mean, he's been on this BBC thing before, but he's never really been interviewed, and he's not on social media. I mean, he's on social media, but he doesn't tweet. He doesn't Facebook or anything like that. He is one of the most legendary traders that I've ever met. And he's doing an interview on Friday with us. And I hope to God you guys can all be there. it's going to be an amazing interview, because he has seen, he managed a trade desk in Tokyo for one of the big banks for many years. Then he managed pension funds, and he's done all sorts of things. He'll tell you, his whole background. But he's seen them all. Like, he's seen every type of trader. He talks to every type of trader. He networks with so many great traders and investors around the globe by phone, because that's just kind of the way he does business, old school. He is, to me, one of the people I hold in highest regards as far as trading goes, and he's so damn good. And and he's gonna kind of tell you what he sees as successful traits of traders and what's gotten him by over the years. And I think, and when I say gotten him by, I mean I've met his whole family, and we've done numerous things together, and he's just an amazing individual. And I hope you guys can tune in on Friday. I can't wait for it, and I hope you guys are all excited for it. So that is happening on Friday. I'll take the helm from Dale. Dale can obviously be here, but I'm and as he probably will be.
Thank you for letting me stay, man.
Well, he's not him and I go.
Yeah, no, I mean, it's cool. I like being in the audience.
I hope you're here, but he's offered to give his his time, and it's very generous of him, and to and give you some of his knowledge on what he's acquired over the. I'd probably say he's been in the markets 40 years plus, and just the
he had a little different result than my 40 years.
His he's done well. I'm not going to
not moderating anywhere.
But the great thing about the great thing about Ronnie is meeting him, you would just think he's the coolest guy in the world, and he's truly a legend, and he's extremely modest and just a really cool guy. So I hope you guys enjoy the interview with him, and I hope you can pull some golden nuggets that will help you succeed over the course of the next years to come, because that's what we do is about. Obviously we built ForexAnalytix as a company to and I'm going to give you guys just a few minutes of background. The market's dead, by the way, so just if you think that there's a whole bunch of great setups here, I'll talk a little bit about that here in just a couple minutes. But I just want to tell you guys, being with WiseTrade for 14 15 years, or how many years I was with that company, I really enjoyed having a place where we could help traders succeed. And when the company has shut its doors as of this year, so end of an era, even though I left a couple of years ago, creating ForexAnalytix to me was creating a place, a landing spot for traders like yourselves that are looking for a community. And you don't have to be on Twitter and get trolled and all that other stuff. But that's what ForexAnalytix is about having a community, having this this webinar. If you're part of the community, you're in the chat rooms, and having a place to land. And for me, it's always been, if we can create a place like this where you guys get great analysis, great technology, a good platform to communicate with one another and talk ideas and trades, that's been what I've always wanted. And being able to deliver great interviews like Dale does on a daily basis throughout the course of the week is just it's icing on the cake. And hopefully you guys, even if you're not ForexAnalytix subscribers now, at least at some point, hopefully you do become one, and you can join our community and be in our chat rooms, with us and communicating with us throughout the course of the day. And as you can see, here's 100 so people, 109 are actually online, but all the people that are in here in the chat rooms talking about markets and I don't know, I just got on a little bit of a rant, but that's why, I guess what I wanted to say is that's why we do these interviews, because this is a safe place for traders, and we don't allow in the Forex analytics community, we don't allow people to to break our rule set that we have, no political talk, and no.
It's all about respect, buddy.
It is all about respect, and we like to joke around a little bit, but
and you know what you had in your mind's eye has manifested. So, you and the Stelioses have created that place that you had in mind when you left Wise Trade. I mean, I've watched it manifest before my eyes in a year and a half. So, well done, man. And I think a lot of people appreciate. I get tweets and everything. They thank us for, the work that we do. So it's, rewarding in that way.
Yeah, and we have such a great team, and that actually does include Dale.
I'm a coach. I'm a player coach, man.
It is, man, and but anyway, I appreciate all you guys, and I hope you guys appreciate these interviews that Dale brings to you every day. Edward NH on Twitter. It should be a very interesting interview. I've been following that guy for probably a good 6-7 years on Twitter, and he's got a great macro mind. I don't know if have you ever interviewed him before?
Yeah, I have.
Okay, yeah. I've never listened to him before, but guy is sharp as a nail. So I'm interested to hear what he has to say. So let me talk about the markets really quick. So as far as the euro goes, and I'm still looking at this inverted head and shoulder pattern. If you're like, well, the shoulders, it dipped, we broke below 113. Also keep in mind that if this is an inverted head and shoulder pattern, it is a complex head and shoulder pattern, meaning the shoulders are cockeyed, kind of like the neckline too.
Yeah, they don't have to be symmetrical.
It doesn't. And oftentimes it's not. So, but I don't want to get excited about the euro dollar until we break above 113.50, 113.60. And I don't think looking at the euro dollar that it's necessarily bullish. I'm just trying to play a little bit of dollar pullback here. I'll get more excited in the event that we're back above 114, and then things get a little bit more exciting. I still look at this as kind of a false breakdown, and that false breakdown down there, I still think is going to yield some upside. But it has less to do with like the technical analysis aspect of the market, and it has more to do with the macro part of it at this point, and it has everything to do with what's going to happen on Sunday, which none of us can really predict, especially when you're dealing with President Trump. We've seen it. It's like I can't tell you how many times this year, I've been in a trade, and then some tweet comes out from Trump and it completely reverses everything that I was just doing. Or, I was in a trade and, I get a tweet and it complements what I'm doing, but it's very random. So, the technicals are a little bit more challenging at this time. All right, so just want to point that out. Now, as far as the cable goes, the cable is actually finding some support down here at 127. I mean, it's trading heavy, and I have a really hard time, and I'm going to have a hard time playing the cable until post-December, I guess 9th, 10th, 11th. I know the vote is on the 11th. It's on Tuesday the 11th. So it's going to be right here is where the vote is. But I think we'll have a pretty good indication which way things are going. The end of the first week of December, so the end of next week, or just before, I would think
around Pearl Harbor Day. So we had Pearl Harbor Day on the 7th, and they're going to have B Day on the 11th. Huh?
Yeah, I guess it may be. and
financial Pearl Harbor maybe.
But I'll tell you this month I'm not, or tell you this much, I'm not super excited about trading the cable right now. I've tried to trade it on the long side a couple of times. I haven't been shorting it as it's been down here the last couple of weeks. I've been a little nervous as we're so close to this 127 level, but it's been frustrating. Every time I get long, it's like, I sever the loss for like a 20 or 30 pip loss, and then I just get frustrated. So I'm just kind of leaving it alone as of right now, but we are challenging some pretty good resistance. We got channel resistance coming in, the previous trend line resistance coming in. If you use ForexAnalytix, you got that analysis about an hour ago. So we're coming up against that resistance right now. The Aussie still a challenge. It's actually holding the previous channel breakout. Now, I'll tell you guys, and I'm going to just kind of reiterate what I told you this weekend. I actually think that the Trump-China meeting is going to go well, at least as it's perceived by the public's eye. We've seen Donald Trump again and again and again and again. He walks away from a meeting with a world leader. He's going to say everything is great. We had we had a great talk and blah blah blah, and we're best friends and yada yada. And then a week later, he's like, China did this, China did that, they got to bend to this, and and after the fact, I don't know if it takes him that time to reassess it, or he just doesn't want to face the music when he's dealing right at that moment with a world leader. But it's always like a couple of days or a week later, he then has different. It's almost like an opposite spin. We've seen it time and time again, whether it's with Putin or Rocket Man, or it doesn't matter who it is, but or with Trudeau in Canada, same thing. Oh, we're best friends, and then he comes back and then he starts beating him up. Probably the same thing's going to happen on Sunday, but the stakes are greater now because the tariffs are really having an impact on the U.S. economy. And if there's one thing that Donald Trump is important to Donald Trump, in my opinion, is stock market. So if you look at the stock market, and that's like a real, for him, I think, and this is the way I view him, the stock market is a barometer of his success. And it seems pretty evident. Even from an outsider looking in, as long as the stock market's doing good, that means that's his, report card, if you will. And, as you guys know, this year has been a little shaky for the equity markets. And I don't think he wants to toy with the market as it's this low. I think his rhetoric would obviously be a lot different if we were trading at all-time highs in the S&P. He would probably double down on his rhetoric. But right now, I think it's a little bit more difficult for him to do. I think he's going to try to play nice, and in the next week or 2 weeks, he's going to start to come down on China again. Hopefully the stock market, in his mind, maybe has recovered a bit before he starts to rant. That would be my opinion. Now, the reason why I tell you guys all this is because if there is a positive spin, the Aussie's really poised for a rally, technically, because we came out of this down channel and we are not coming back into the down channel. So as long as we trade above 71.50, I have to think that the risk of the Aussie of moving higher is high. And you look at the Kiwi, the same thing with the Kiwi. Kiwi's got a nice little bull flag here. It's you can call it a bull flag, or it's a bullish move, and we're holding through support. So I think
Blaker, less than 1 minute away. Sorry to interrupt you. Less than 1 minute away from preliminary GDP third quarter.
Thank you.
Yeah.
I'll just cover that really quick since my positions are very minimal. Let me take a look at here's Bloomberg, just so you guys can see it. This is advanced GDP. That's good trades. There's GDP annualized 3.5%. Actually, there we go. Core PCE is coming out. GDP price index. Here's the number. We're expecting 3.5%. So you'll see it here first. I don't want to lose my Bloomberg, so I'm going to actually move it right here. 3.5% in line. PCE came in a little worse than expected. Retail sales came in better than expected, and it's overall mixed. Inventories came in a little higher. Personal consumption a little weak. Good trade balance. Yeah. So, you know, it's a little bit of a mixed bag, and I think everybody's waiting for Powell. So that's going to be the mover. So, all right.
Personal consumption quite below consensus, 3.6 versus 3.9. Core PCE a little bit weaker. GDP right on spot. So, you know, more or less a little bit. Trade goods trade balance 77.25 negative. But by the way, for those of you that are wondering, this is another all-time record negative trade balance, meaning that I don't know what Trump thinks, but you know, since some things are only can only be judged by numbers, this is the second consecutive month that we hit all-time record lows, all-time record highs in negative trade goods balance. And I see that you're giving me the screen, Blake. You can see it here. You can see just 2 years back, but trust me, these are all-time lows that we're hitting here. So the U.S. Tariffs or not is definitely not winning any kind of trade war at the moment. At least the numbers show that it doesn't.
All right. Well, with that being said, Steve, I'm going to pass it over to you. Guys, don't miss Friday's interview, and that will be at 9 a.m. Eastern. So it's going to be during Dale's normal interview time. So thanks, guys. It's all yours, Steve and Stelios and Dale.
Good hunting, Blake.
Thanks, guys.
Thank you, Blake. Stelio, if you can, before you say whatever you want to say, can you give us a little bit more of the qualitative data of the GDP? Because I think the breakdowns of what constituted the preliminary GDP come out, and usually, I know that a lot of people are not paying attention to that, but usually breaking down where the GDP growth comes from can actually act as a leading indicator in, you know, if we should be looking for you know, weaker or stronger growth ahead. So, for example, you know, if a lot of it is due to let's say inventory build or whatever, you know, those are, for example, negative signs. If, for example, a decent chunk of it is investment, that's a positive sign, etc. So do you have the breakdown?
I actually don't have it. Sorry, I don't have it right now. I can have a look at it in a bit if you don't mind.
Okay, please do.
Anyway, I'll have a look at it. Don't worry. But before that, I just wanted to talk about a couple of things, the usual things actually. So, but we had some developments in the UK, so it's worth mentioning them. I'm going to start by the EU and Italy though, because it's our daily dose of slight comedy. And you know, remember after many days of the Italians, you know, Salvini and Di Maio saying there's no way we're going to negotiate a budget deficit and it would be suicide, etc. They have now opened the door. And they have said that they could potentially look at a reduction to 2.2%. And this is after Pierre Moscovici, the European Commissioner for Economic Affairs, said that it's this very serious Italy deviation must be corrected. And Dombrovskis said always substantial correction was required. You know, there was a lot of pressure from the EU side, and it looks like the Italians have cracked. What does that actually mean? You know, they might say, oh, okay, we're going to target 2.2%. What comes out in the end could be completely different. So in my opinion, this is all just talk.
Look. That's the fun part, that you can easily say, yeah, sure, we're going to take that down to 2.2% and basically not even take action, so you can take it down to 2.2%, just, you know, fudge the numbers a little bit, you know, and then do whatever you want to do.
Where's all the amore?
I love Italy, but in this respect, you know, it's I read the comments and I just laugh. But anyway, it's a different story. And the other thing, obviously, is the UK, where we had a few more developments. The issue with Gibraltar has now been fixed. So initially, the Spanish government said we're not going to approve this this EU-UK agreement. Even though it doesn't have to be unanimous, obviously it's not good to have countries who are not voting for it. So that was fixed. And then after May, hearing Prime Minister May for weeks saying this is the best deal and the only deal that we will have with the EU, we have to vote for it. Suddenly today, she's back down, and apparently there's going to be an allowance for lawmakers to renegotiate. This is something that could open the door for a second referendum. I think it's unlikely because she has said repeatedly there's no way we're going to have a second referendum. But then again, politicians say a lot of things and then the opposite things happen. Or this can obviously open the door for a different deal, which is more likely. Maybe something can be changed, and then again, it's a big hurdle to overcome because the whole of the Labour Party, the whole of the DUP, a big chunk of Conservative MPs, they've said they're not going to vote for it. So if if the window is open for it to be changed, that might be considered a positive. And the pound in the last last week or so, even though all these headlines are coming fast and loose, it's not really doing much. So either whatever is priced in for the vote is heavily skewed. So basically everybody thinks that there's no way it's going to pass. So no matter what comes in terms of headlines, it doesn't change that. Or maybe just like me, people are a bit tired of all these headlines, and they don't give them that much thought or consideration until there is something firm. The other important thing that happened today is that the UK Treasury made some projections based on what could happen. And surprisingly enough, actually, no, it's not surprising, but a Brexit deal or no deal would be, they're saying it would leave the UK worse off than if it was actually to stay in the EU. And they brought out some numbers, which I really don't know how they come up with them because they're 15-year projections. But apparently, compared to staying in the EU, the UK economy would be around 4% smaller than it would have been after 15 years, or with a no-deal Brexit, that could be up to 10%.
Yeah, you can build a lot of statistical models and project ahead what's going to happen under several scenarios. So mathematically speaking, it's valid. But on the other hand, we know that looking down the future so much with so many unknown factors, I mean, it's just a mathematical challenge. I mean, you do it because you have to do it and, show something or at least have a comparative basis. But it's very easy when you're projecting so far in the future, even if you have like one wrong input or one wrong assumption in your inputs, it can completely skew the final results that go so far ahead so much that it makes no sense. So
yes, I mean all these things, and other MPs talking about that if we go on a no-deal Brexit, there's going to be water shortages, and I don't know, that we're going to run out of toilet paper. I don't know what. This is part of this, what people call the Project Fear. To make people think that no-deal Brexit will be the end of the world. I don't think it's going to be the end of the world. Obviously, it's going to be a little bit challenging for the first year or two. But then how economies are, how markets are. They find their balances.
You see what Kostas is writing.
What is he writing?
65% of GDP inventory growth.
Okay. Thank you, Kostas. Thank you.
That's why I was saying that we should have a, it's always good, besides judging the number, it's actually a good idea, of breaking down, the qualitative data of a GDP growth, because it matters where it comes from. I mean, where does it come from? Does it come from investment, for example? That's going to be amazing. Does it come from just building up inventory? That sucks, because it shows that in essence you're not building, you're not building something that can. Hey, Costa. Costa, I just unmuted you. We can hear you.
Yes, hi. And just so that you were talking about it, so that Zero Hedge posted that 65% of GDP was from inventory growth.
Yeah, which says a lot. By the way, this is Kostas. We used to work together in the same fund. he's a very experienced guy in the market. So, Kostas, they haven't met you before. So since I saw that you are online, Kostas is very experienced with the markets, working with Bloomberg Terminal and doing some quant analysis as well on occasion for many, many years. So I know Stelios and I both know Kostas in person.
With the Stelios.
Yeah. So Costa, the qualitative data of the GDP are actually not good at all, right? Inventory based.
Yeah, it looks like that. It looks like that. So, but I guess the market reaction is muted because everybody waits for Powell.
That's very true. That's very true.
So it actually is Davis.
Yeah. Okay.
Actually, one more thing I just wanted to mention. Then you can go and do whatever analysis you like. Actually, what I thought was quite interesting and is Carney. He spoke a couple of days ago, and he said that in the event that we get a no-deal Brexit event, the Bank of England would have to probably respond by raising rates to defend the currency. Now that could be, that might sound a little bit odd because, a no-deal Brexit would imply a drop in GDP, perhaps a recession. But we've seen this happen. Central banks hiking, not 1,000 basis points, but something to show confidence. It's a signal towards the market.
First of all, to show confidence, and second of all, it's more than certain, Stelio, that if you are to go in a recession, let's say because you have a hard Brexit, you'd rather have a little bit of a stronger recession, and that's it. So you take the pain. You let the market go through its normal cycle and then recover, then perhaps end up with something much worse, which is much tougher to heal afterwards, which is, for example, the possibility of having at the same time a recession and inflation. So in essence, stagflation. Because if, for example, the pound gets hit strongly, and at the same time the economy gets hit strongly, you might have inflation as well. And those two, you can't fight at the same time inflation and the recession. You can only fight one of the two, right? Because the medicine for one is poison for the other, and vice versa.
Yeah, a lot of countries have to raise rates to stem capital outflows. They don't raise rates because of economic growth or to try and take the punch bowl away. A lot of it is just, we'll pay you some more money to hang out with us.
Yeah. Turkey did that recently, right? So
all those currencies that have been under a lot of pressure, all of them did rate hikes to stop capital outflows.
Yeah, and the sooner you realize and the sooner you take the pain, the less pain you have to take. And Turkey is a great example, because if Erdogan had allowed the Turkish central bank to actually function independently a couple of years ago, when they had the first crisis, the first currency crisis, and Kostas can tell you a lot about it, because Kostas used to work for years, and I can unmute him again, in a fund that used to do a lot of trades in emerging market currencies. So Kostas has been on the wrong side of these trades for a long time, until they finally ended up making money, because they had a big portfolio, so they could hold on to the losses and at least have the carry trade. If Erdogan had
no advice to anyone.
Yeah. At some point, how much underwater were you, Kostas, in that ruble position a few years ago?
Well, at some point we were like 1.5 M in the ruble at 60, and then we went to 100 during the Christmas.
Yeah, 1.5 million down in long ruble position, and in the Turkish lira.
Well, that's something similar in the market. It was a little bit better on the Turkish lira because the move was not so sharp. It was more gradual.
Yeah, at some point, and then it accelerated.
Trades, you need to, if you play the carry trades, at the end you need to manage to enter and have a very strong stomach in order to play those, at least the last years. And it was also similar to BRL at some point and everything. I mean,
Yeah, exactly. So Kostas used to actually be in a fund that traded a lot of emerging market currencies. So trust me on that. You need, as Kostas said, you need to have a strong stomach for that. And if, for example, Erdogan had let the Turkish central bank act independently a couple of years ago, when they had the first like big depreciation, because the Turkish lira was depreciating for many consecutive years, but at some point it accelerated higher, then it paused for a while, then it accelerated again. So if he had let them do what they had to do back then, Turkey would not have actually got to really the precipice of a disaster, because when the Turkish lira reached this point, and as Blake said before, today we're more relaxed in talking about things like that simply because the market hasn't been doing much, and probably it's not going to be doing much until Powell. So when the Turkish lira reached and exceeded like 7 against the US dollar, that was more or less, I mean, it was proven that, you know, the Turkish banks cannot survive this exchange rate for more than, you know, a few weeks. So in essence, when Erdogan, you know, let the Turkish central bank do what it had to do, you know, they saved the situation just on the precipice of a disaster, but they could have easily lost completely control of that. While if they took the medicine a lot earlier, which was, for example, here, I mean, you know, things would have been much better for the Turkish economy. Perhaps they would have gone into a small recession for a small period of time, but, you know, things would have been in the medium to long term, you know, much better for them. It will go there again, says Kerem, which has boots on the ground. Local elections in June. Yeah, I do believe that this is a corrective move lower, Kerem, and I do think that Turkish lira is approaching now the 200 daily moving average. Also, we have these previous resistance levels at 490. So I also do believe that this move lower is not going to be long-lived. But on the other hand, I think that they might have learned the lesson. So I think that they might manage to hold it below 7 at least. Of course, you know, other factors we're going to play a role. Now, let's go ahead and have a look at a few of the things that have been moving, because let's be honest, in comparison to yesterday, we have very few things that have been happening. One of them is that we have a more extended rebound in the S&P, and which is currently testing the first actual area of resistance. So what happens from here? Do we get rejected? That opens the door for a straight down move. I think the next target is going to be 25.30. If we do break above, then we're looking for something like a triangle or whatever else. You know, it's very hard with corrections predicting in advance what the case is going to be. But keep in mind, as I said a long time ago, the bullish scenario is some kind of a fractal nature of what happened there to happen here. So more chop trade, then higher. This is the most bullish scenario. But even under the most bullish scenario, there are two things you should take into account. First, volatility is not going back down to single digits. You can forget about that. I'm pretty much certain that volatility is going to stay decently elevated until the point that we actually get a bear market, which isn't far away, even if we hit new highs. And the second thing is that even under the most bullish case scenario, there is still going to be money to be made both higher and lower before we can actually, before the market can actually decide on a direction and start moving towards that direction again. Having to do with history, and because you have to respect the trend, you know, you always have to act under such a scenario like the vast majority of the chances are that the move is going to be to the upside. But for every single month that passes, already being in the longest bull market in history, you have to take into consideration that there is a big chance that at some point what starts as a correction, because there is absolutely no bear market that doesn't start as a correction. I mean, having to do with definition, a corrective move is anything that takes you lower than 10%, and a bear market is anything that takes you lower than 20% from the high. So there is no chance you can go in a bear market before you pass the corrective market territory, right? So I know that the market is conditioned to treat everything as a correction that will lead to higher prices, and that will keep working until one day it stops working. And there is an old adage. I know that if you read it in English, it's called adage. But it's not an English word. That says that the markets fall a slope of hope and climb a wall of worry. So every bull market, especially at the first phases, everybody is looking when it might turn down and go lower, because the recent past had a bear market in the price action. So everybody's very worried that a bear market might reinstall itself like quite fast, and that's why we say climbing a wall of worry. But on the other hand, near the end of a bull market, the market falls down a slope of hope. Why? Because everybody that's conditioned that any dip should be bought, the bear market begins. You don't know yet that you're in a bear market. Everybody treats that as a correction. So they start applying the usual tactics that you do in a correction. I mean, looking at your indicators that, you're expecting to be told when there is a good point to be buying under the assumption that this is still a bull market. And then you find yourself on the wrong side of the market, but you still believe that, okay, perhaps this is a deeper correction, and then you find yourself again in the wrong side of the market until you finally capitulate and you understand that this is a bear market. But, a lot of money can be lost that way. So, one thing is for sure, this is a bull market and you need to respect that until it proves otherwise. But at the same time, this is a very mature bull market, which means that the chances that some of these corrections, this one or the next one, is going to end up being the bear market, especially considering that the qualitative data of growth globally have started showing big signs of a slowdown. Anything that has to do with the US consumer, for example, and we know that the US economy is based 70-75% on consumption. The auto industry, the housing industry, they've been showing really, really worrying signs. And usually those are leading indicators that something starts smelling bad, something is starting to malfunction. So I would advise against being very, very bullish in any case. So regardless of what's going to happen, if we do break above 2690 and we do close above 2690, you can obviously see that the next level of resistance is going to be once again 2812. But I have to tell you that personally, and I was talking, coincidentally a few days ago with Kostas about this, I would want to see a move up here. And why I would want to see a move up here? Because I believe that if we do see a move up here, there is a lot of people in the market that are going to be convinced that this is the corrective move that's now over. And people are going to start getting really long. And I think that the correction is not going to be over, even if it's a correction. So I would want to start building a position up there, because I would want to see then another sharp leg lower before considering the possibility that this bull market can continue. So personally, I have shorted this market 4 times. I was lucky enough to make, since we had that correction, I was lucky enough to make money every single one of those times. I'm not looking to have a position yet because it's not easy to read or easy to establish a decent reward to risk ratio where we currently stand. But I would definitely be willing to do that the closer we get to this confluence of resistances, which is at around 2870. I believe that can prove to be a very nice bull trap. So no need for me to look through the rest of the indices, because more or less, the S&P is the broader index. It has the vast majority. First of all, the S&P has a representation from all the different industries in the US, so it gives you a very good idea of what's happening generally in the market. So when you want to do a top-down analysis, the S&P is more than enough to get an idea. Now, of course, if you have a look at the Nasdaq looks less bullish than the S&P does, simply because the stocks that were leading the rally higher were actually leading the corrective move lower, but still you can't, I mean, from a technical standpoint, you would expect to see at least this was an ascending wedge and you would expect to see a move down here. Why? Because we know that ascending wedges have the tendency to retrace the whole, the whole structure, the whole pattern in actually a fraction of the time that it took to build. Statistics have shown that actually ascending and descending wedges have the tendency to retrace the whole pattern usually between 1/3 and 50% of the time that it actually took to build it. Okay, so quite a lot faster. I mean, in half the time, sometimes even in 1/3 of the time, you will end up retracing the whole move. That is one of the reasons why ascending and descending wedges are some of the favorite and best patterns to trade in the markets wherever you find them, because they produce good reward to risk ratios, and since you expect the breakout from a wedge to always be volatile, to always be fast, to always have momentum, at least you know that you are wrong. If you see a breakout and there is no momentum building up, you know that perhaps you have the wrong interpretation, because as I said, when wedges break, you want to see momentum, because that's how it works. By the way, I was just looking at the same time qualitative data. The GDP print of this quarter, if we completely exclude inventories, would have barely been positive 1.2%. That's not a good sign, because as you very well understand, you can count inventories. Inventories are counted in the GDP. The problem is that then once you get offload of the inventory, so for example, when a company sells those inventories, so when you get draw down an inventory, you cannot double count that again in the next quarter, right? So in essence, why is inventory building a negative sign for an economy? Because in essence, you move forward growth that in essence is meant to be for the future. So if you have a buildup in inventory today and you draw it down in the next quarter, you've already taken into account those sales that will happen in the next quarter in this quarter. So for example, seeing something like that, then if you see a huge miss in the fourth quarter, that shouldn't come as a surprise. You understand what I mean? Because if the companies now stop building inventories because they consider that they already have enough, and then in the next quarter, for example, you have no positive effect from inventory building, you might see a horrible number, a 1% number, for example, or even lower than that. It depends on what other things come into effect. Now, one last thing that I wanted to show, which actually has moved, is the euro and pound crosses, simply because I believe, even if you see it on 4-hour charts, I believe this is what we drew several days ago in the Euro Aussie. I believe that the corrective move higher have ended. So I would be looking for a new low in the Euro Aussie, for a new low in the Euro Kiwi. And if we go down to the 4-hour charts, you can see this pound Kiwi hasn't broken down yet, but as you see this, now I'm at the 4-hour chart, pound Kiwi, as you see, this move higher is lacking momentum, so it looks like it wants to break lower. This is the pound Aussie, might have already completed this correction, and perhaps this is just a pullback to retest the breakout level. So it looks like all of those crosses want to push lower once again. Keep in mind, though, that although the moves lower look impulsive, I do think, as Gregor was showing, and I totally agree with him, that this is the first level of probably a zigzag or an irregular correction or whatever. So this is a 5-wave move lower that will complete rather soon. You should expect, though, a rebound, a strong rebound after a new low, which I think is going to produce a very, very good shorting opportunity once again. So, for example, I would want to see now, let's say in the Euro Aussie, Euro Kiwi, for example, that we have here, I would want to see some kind of a move like this, getting people trapped short at the wrong place, getting a rebound to retest perhaps this level, and then another leg lower. So something like this is what I would expect in general from those crosses to produce, the Euro Aussie, Euro Kiwi, Pound Aussie, Pound Kiwi. So, you know, if you want to trade them in the short term, I think another low is in the cards. But if you're looking to trade them, to have a better reward to risk ratio, I would expect a bigger rebound and then a nice opportunity to sell them, looking to make quite a bigger profit in doing so. Coach, I know you have an interview.
Yes,
and
buddy.
know it's exactly. Okay, so
we're going to be talking debt, Steve. Your favorite topic.
Perfect.
Debt is slavery and bondage. The whole world is chained up in debt.
The worst thing with debt. The worst thing with debt, Coach, is first of all it's completely unsustainable. So in essence it's one of my favorite topics because it's important, but it's one of my worst topics because what debt is, in one sentence, is a transfer of wealth from future generations to the present.
And you know what? And you know there was wisdom in ancient societies having jubilees. To wipe the slate clean and give people a chance to start over. So they didn't have bankruptcy then; they just forgave debt. So anyway, we may have a jubilee here in the globe before it's all over.
Perfect. So enjoy the interview. Right. I'm going to be listening and see you all tomorrow. And let's see if Powell can actually produce some volatility in the markets because the last 24 hours have been more or less boring, let's be honest.
Yeah, go Paul, go. Flap your lips, man. And now I have the pleasure of speaking to Edward Harrison. I'm going to make Edward a panelist, and then I'm going to show his website. So I'm going to take the screen over. Edward, thank you so much for joining FACE again. In fact, FACE for the first time, I believe. How are you, buddy? Let me see if your mic's okay. I see it. I see it, but I don't hear you.
No, we heard something in the background.
Yeah. I don't know if the mic was working right, but your mic is active?
I think it is active.
Yeah, Edward, listen to me. You sound far away. Please, there is a drop-down menu on the panel on your right-hand side which says audio. Make sure that you have selected the right mic because perhaps by default there is another mic selected because you sound very, very far away.
Yeah.
Okay.
Are you using a headset mic or?
I'm not using a mic. I probably should. How about now? Is that closer?
Yeah, that's better.
Yeah, that's a lot closer.
Great.
That's loud and clear, Edward. How are you, buddy?
Good. How are you doing?
Okay, now you're soft again. So we're having technical issues with the audio. Why don't we just try and move ahead and see how it goes? I don't know. It might be the hardware that you're using. So,
properly.
Excuse me?
I probably didn't set it up properly.
Yeah. Well, we'll try and move through this and see how it goes. So, I appreciate you taking the time out of your day to be with us, and your bailiwick is credit. I'm showing your website here, credit write-downs. Looks like you have a lot of great content as usual. I believe the last time I interviewed you was a few years ago on FX Street, if I'm correct.
That's right.
And yeah, so Paul is speaking today, and the big question is the Fed in December. Markets seem to be pinning their hopes on a dovish hike, that we get the hike and some dovish language. What's on your radar regarding that, Edward?
Really, you were looking at a potential acceleration of the policy hike into 2019 going forward, because we make what they consider that we are at the right level or even above that.
I'm so sorry, Edward. It's barely legible. You know, we could barely understand what you're saying. I think we're going to have to reschedule this and see what the story is with your mic. I know you do a lot of interviews. I'm not sure, you know, what you use for audio. Yes.
Probably he's using a bad microphone, but there is an alternative. If
Call
he's
in.
if he's in the US, he can just use. He can call in, and the quality is going to be perfect since he has a problem with his microphone.
Okay. The call-in number is on the website. I don't have it handy in the GoToMeeting.
Don't worry about it. I'm going to give it to you. That's not a problem.
Okay.
But is he in the US? So can he call in?
Yes. You're in the US, Edward, right? I think that's a yes.
Okay.
If you'd like, there's a call-in option.
Yes.
Okay. Let me give you the phone number, Coach. That's the phone number he has to.
Okay. 1-415-930-5321, Edward.
And then I'm going to give you an access code, since people are going to see it, which is going to be only for muted. Then we can unmute him afterwards, okay? And this is the access code he has to put in. He's going to be muted by default. We have to unmute him with this access code.
Right. Okay. I give this to him.
Yeah, because once he calls in, he's going to be asked for an access code.
Okay. Edward, can you hear me? For the access code 555-784-689. Thanks for your help, Steve.
No problem.
You're a great co-anchor and producer.
Thank you.
Self-muted, it says.
Yeah, I think this is the other access that he has through his computer.
Right. So I don't know.
He's still online with his computer. Now he can access through the phone.
Okay. Give it a couple of minutes so you guys know what's going to happen with rates and what parts of the debt market could be vulnerable to more pressure and what may be values. So just waiting for Edward. Yeah, you should have been here by now.
If he has any problem, he can type in the question box and I'll see it.
Yeah.
I'm looking at it.
Right. If you're having an issue, Edward, type it in the question box. Let's see if he's trying to message me on Twitter. Nope. Well, I think we'll have to reschedule. What do you think, Steve?
Yeah, let's give him one more minute, and yeah, if he's not in through phone, absolutely.
Tomorrow we'll have Lydia. The cable queen
nice.
will be with us.
Nice.
Or investing.com. Lydia never has technical difficulties.
Yeah, that's and you know,
sometimes it's the first time I bring people into the GoToWebinar format. They do, you know, because a lot of people aren't prepped with good microphones. So I think we'll have to reschedule this with Edward. Really wanted to hear what he had to say, so I'll work him into the schedule soon.
Okay, coach.
Okay, buddy. So sorry about that, guys. Edward is a great follow. You could follow him at Edward Harrison on Twitter. And I will get Edward back here. Maybe we could have him back before the Fed meeting in December. Good hunting the rest of the day. Want to thank all our new members, that have entered our community. We're here to support you. Our mission is to build up and edify traders every day. And most of all, my friends and trading warrior brothers and sisters, don't just count your pips, count your blessings. Glad to have you part of our team, our community, and see everyone tomorrow. Good hunting. And Blake and Steve and 100 pro traders are in the private member chat. So every day that space ends, you have somewhere to go. Adios, everyone. Have a great one.